We are back on another episode of the Lone Star Capital podcast with a fun theme today with the founder and CEO of the company, Rob Beardsley. How are you today?
Excellent. How are you?
Incredible, overcoming this disgusting sickness during the worst time of the year. But we're going to be positive today, and we're talking about something very important, which is actually us and kind of a reintroduction of our company, who we are. One of our friends and clients actually messaged us saying, hey, do you have anything high level I could just send to my people? So shout out to him and the referral he just sent us, and then hopefully more to come. But he's probably not the only one who might be thinking of this. And sometimes it's good because you could be a new listener here. You could be new to us, new to syndication. You could find this episode in 6 months from now, but this could be your kind of North Star and for you to figure out exactly who we are, what we do, and the breakdown. So with all that said, Rob, why don't you introduce yourself once more, like no one's ever met you before. The recurring listeners don't know you. Go through your background, soup to nuts, where you grew up, the whole nine.
Absolutely. Sure. So my name is Rob Beardsley. I'm the co-founder of Lone Star Capital. My business partner, Kent Petrikovsky, and I, we started Lone Star Capital back in early 2018 to focus on acquiring multifamily assets in Texas. And growing up, I actually grew up in a real estate family in Silicon Valley, California. My parents ran a residential brokerage firm, ran the business from home. So I was around them talking shop all the time. My dad would bring me to construction sites in diapers. So I was around real estate growing up, but didn't really think that I would actually have a career in real estate because actually I saw my parents struggle so much in it and they didn't glamorize it nor encourage me to get into the business. Actually, the opposite. They said, look at what we do. It's very hard. Look around at our neighbors. Everyone's doing this tech stuff and these startups and they're making a ton of money. That's what you should go focus on. So I pursued a degree in information systems, which is a blend of business and computer science at Carnegie Mellon. And that's when real estate kind of hit me. And that's where I actually started discovering the different strategies available in real estate because it's a very broad market. And I got involved in multifamily, started researching a lot about it, studying it, living it, going to different conferences, going to local events, and just talking to brokers about deals. And that's how I met my business partner. And then shortly thereafter, Kent and I, we started the firm. I dropped out of college. He left his job at MetLife. He was formerly a tax attorney. So he had a 12-year corporate career prior to starting the firm. And I relocated to New York City, which I'm here now. Kent grew up and has lived his whole life in New York. So it was a very natural fit for us to start building the firm out here, all the while focusing on acquiring and managing Texas assets.
Right. So did you always want to move to New York, it sounded like, or, what kind of got your fascination to be there? And then why did you choose, I guess, the headquarters of the office to be in New York? Was it just convenient? Was it just a perfect match? And then, obviously we haven't always been in the One World Trade Center. What was kind of, the starting point? Because the company was founded in 2018. So can you kind of take us through the breakdown of, employee buildup and things of that nature through kind of that process? And then also, can you spend a little bit more time on breaking down why Texas?
Yeah. So these are all questions that we get a lot. So they're great questions. People always ask, oh, well, you're Lone Star Capital. That means Texas, right? Well, wait, why are you based in New York? And then, well, if you're in New York, why do you focus on Texas assets? So it's a little bit confusing, but it's pretty straightforward, actually, because essentially, irrespective of my career, you're right. I had a dream to live in New York once I discovered the city. When I went there for the first time around 18, 19 years old, I made a point to myself, hey, I'm going to make it to the city. So I had an internship as a data analyst for a summer and had the best time ever. So I just wanted to keep coming back and make a goal to move. And so it was just a perfect fit that my eventual business partner grew up in the city and lives here. So that was just easy decision for me to want to move to New York. And then obviously there's so many benefits to New York when it comes to business. You have the strongest talent pool potentially in the world. You're rubbing shoulders with kind of industry leaders and highly ambitious people. So that all just fits well. And then the Texas thing, why Texas? There's really less magic about that. Yes, Texas is one of the best markets in the country, but there's a lot of great markets that you could be successful in building a real estate portfolio in. So Texas isn't any sort of magic decision. It was just a decision that we made. And I think the right decision that we made was not that we picked Texas, it's that we stuck to it. The problem that a lot of people have when they get started, and this goes to many things, is they become a tourist in an asset class or in a business strategy, and they kind of hit some bumps in the road or hit a roadblock, and then they pivot and try to go to where the grass might be greener. But the reality is anything worthwhile is hard. And so the important thing is actually sticking to something, building up the expertise, building up the relationships so that you can actually have compounding benefits rather than just always going up the learning curve, up the learning curve. So the reality is basically we got our first deal awarded to us in Houston back in 2018. We closed on that deal in July. And then in June of 2019, we closed our second deal in Houston. And really the only reason why we closed that second deal was because of the reputation and the benefits that we gained from closing the first deal, right? Closing the first deal in Houston kind of put us on the map ever so slightly, and it allowed us to get enhanced deal flow and things like that. So those are some of the pieces of the puzzle that have led us here to where we are today, sitting on a $700 million, 5,000 unit portfolio comprised all in Texas. We're vertically integrated, all these good things that we'll cover in a minute. But I also want to break it down a little bit more. And you might be actually better at breaking this down since you talk to our investors all the time and new investors and explain to them exactly what we do and how working with us looks. Because I think a lot of people may not even realize how this is possible, or that this sort of investment opportunity is available to them. Furthermore, similarly, 1031 exchanges, a lot of people don't know about that, or that it's possible in a deal like this. So yeah, can you kind of just break down
Yeah.
the very basics of a syndication?
Yeah, well, real quick before we get into that, I think one thing that we kind of buried a lead on there, if you will, is going into Texas, because Texas now is, oh, well, of course we want to be in Texas, right? But you got into that pre-COVID, in a time where, regulation wasn't as crazy, or I guess not regulation per se, but politically speaking, there wasn't as much movement. There's obviously great growth in Texas. It's pro-business. Being from California, where you're from and I'm from, and being from where Kent is from, New York, Texas is a great place to be because it's, more landlord friendly, but you were there prior to being as trendy and cool per se. So that was kind of a unique, item there. And then it obviously had really, really great tailwinds following that. So it wasn't just, oh yeah, post COVID, it was a no brainer. I think it was obviously a logical choice, but it looks even smarter now in retrospect. So I think we're almost failing to mention that. It was just really fortunate circumstances there as well, which is pretty cool.
Yeah.
Yeah.
The beautiful thing about real estate, not to get too sidetracked, is that the trends are typically very long, and it's not like a short-term trend. These are long-range trends. People have been moving from the coast and have been moving to more affordable cities in the Sun Belt region, such as Phoenix, Texas, Florida, Atlanta, the Carolinas. So I just listed off a lot of great markets. So again, Texas isn't the only great market, but it's certainly one of those that has been benefited from these big long-ranging trends. And then to your point, COVID exacerbated those trends and just really added fuel to that fire, because more people just wanted to move. They wanted more space. They wanted more affordability as things have continued to get less affordable. And then we also kind of saw some of the ways bigger cities, more liberal cities kind of not do so well during the COVID era.
Well, there was also, I think they believe the phrase or the terminology is a moratorium, if you will, on rents. And a lot of people, or a lot of cities,
Evictions.
a lot of cities, like let's say Atlanta, obviously Southeastern, places like that, places like Colorado, places in California. Basically, well, guess what happened? Landlords had to pay the mortgage, but tenants didn't have to pay the rent, which is kind of a problem. So there was a lot of kind of backlog there versus Texas. No, both parties were obligated and contractually had to pay their end of the bargain. So we got very fortunate there. A lot of people got crushed due to that in those said markets. And it's just very unfortunate how that occurred. Obviously, COVID was, a black swan of black swan events. No one wanted it to happen, but certainly some people did, in fact, take advantage of it. Fortunately, being in Texas, we didn't have to experience that as much as other people did in various different places of the country. But then you mentioned, back to kind of moving the conversation forward, what is a syndication? So let's say if you are in a downtown area, if you are in downtown Phoenix, if you're in Scottsdale, if you're in New York City, if you're in Austin, Texas, if you're in San Francisco, you're going to see a beautiful commercial building. It could be an office building. It could be a multifamily housing complex. It could be an industrial piece of real estate. Okay, who owns that property? Well, it's actually not just one really rich guy. It could be, but by and large, it's actually a pool of investors, which is known as syndication. So you've got fractional interest and ownership in a property. So this could be comprised of 100 investors who have checks ranging from $100,000 to $2 million. It could be a couple of $10 million partners, so on and so forth. But it's pooling people's monies together to buy a property to have interest in that opportunity.
Yeah. And so a couple big things about this are, to you and I, and to a lot of people listening, probably this might be old news, or it might be like, well, yeah, of course, this is how it works. But this is actually, I would say, new to a lot of folks. And it's new in general because this stuff wasn't really possible. That is syndication prior to the 2012 Jobs Act, when basically they deregulated the ability to raise capital. So now we're able to issue securities through SEC exemptions under Regulation D, 506B, or 506C. And this allows us to legally and compliantly through the SEC actually raise capital. So that has been one of the big things that has opened up the door to this syndication model to proliferate and to actually scale. Because obviously, people have been pooling capital together, like you just mentioned, for a very long time to buy real estate. But now you can actually do it in a much more systematic way. And another huge element, and I would say like 50-50 piece of the puzzle, is technology. Because when it comes to managing 100 investors with 100 checks, like you just said, that could be very overwhelming, doing on a spreadsheet and keeping everything together and managing the privacy and protection of the sensitive data of the investors and things like that. So with technology, that stuff's all just easy now. So now it's no problem to have 400 investors like we have in one single offering, just as an example. So those are the two magical pieces that have really allowed our types of business models to be successful and flourish in this new regime of technology, 2012 Jobs Act, so you can raise capital compliantly. And then you could also make a point of kind of like the social media age, where we can do podcasts like this and we can reach a lot of people rather than being confined to going to our country club and kind of asking for our rich buddies to invest.
Yeah, I was actually going to mention, the old days of doing this was probably, the, hat in the middle, if you will, figure of speech, country club raise, which is still a very, very viable way people do raise money. And some people only want to work with said people like that. Some people are more like us, who we kind of put ourselves out there far and wide in a compliant perspective to kind of attract a very large audience and build legitimate relationships via the internet. It's absolutely wild how many people that we actually meet through this medium that work with us, invest with us, that we've got now personal friendships and relationships with, that will honestly be everlasting, hopefully, which is super cool. But back to the syndication route and kind of what it is, I think the other thing as well, which is super cool, is that people kind of look at those really gorgeous Class A properties, whether it be gorgeous properties, like behind me, the One World Trade Center where we're built in, places like that where, oh, well, some really rich person, some bank owns that. And yeah, it could be the case, but you also can have a piece of that pie as well. So there's, I think, historically speaking, a lot of limiting beliefs behind the investment opportunity, just by and large, generally speaking. I don't think a lot of people realize that you do actually, in fact, have access to these opportunities. And then, syndication is also, I would say, slightly synonymous with the alt space. The alt space is alternative investing. Alternative investing, although I don't feel like multifamily is truly an alt, it's probably the least alt. It's probably the most mainstream thing because apartment investing has been, historically speaking, one of the more recession resistant investment vehicles probably in this country, at least in the last 30 years, I would say. Rob, correct me if I'm wrong there. But it's a great hedge against inflation. Obviously, the Fed can't print more land or apartment complexes below replacement costs naturally. So those are some of the theses behind it. And we can kind of get into some of the more of the kind of the reasons why apartments and honestly, frankly, why us, of course. But syndication super cool because you get a piece of that pie now and access to it. If someone tells you should have all your money in alts, it's a little silly. You probably want to have a piece of your net worth, a piece of your pie, make annual contributions to this, as you likely are into your IRA or your 401k, the S&P 500. All fine places to park money, maybe some of it in crypto, but you should be looking likely, or, I think I invite you to look at this as an opportunity to expand your horizons and have kind of dollars here outside of what you're currently doing. And the other really cool thing about syndication is guess what you don't have to do? You don't have to sign on the loan. You don't have to be a grantor. You don't have to get your credit pulled. So a lot of people want to be in real estate, want to invest in real estate, but they maybe are too young. They don't have the credit to do it. Maybe they're tapped out. Maybe they own, 7 properties and, they're a landlord that really can't scale up any more than what they currently have on their plate, but they want to have a diversified opportunity and have it be truly hands-off and passive. And that's the opportunity that we present to them. So I think what I'll also do is talk about the experience that our people get at the end, which is a good note here. But that is what a syndication is. And then, Rob, if we want to segue here into kind of our mission statement, our North goal, our North Star, and kind of our goal eventually from an AUM perspective, just our holistic kind of future vision, to reshare that, I think that'd be really impactful for those maybe who don't know us and those who listen to us to kind of have a sense of where the ship is going or ideally will be going, inshallah.
So let me add on to what you said as well, because the alt space, it's a funny term, because kind of for a lot of traditional personal investing or advice, it's the 60-40 allocation, 60% stocks, 40% bonds. And a lot of people view that classical wisdom as dead. I'm not going to say that that's necessarily right or wrong. I think it just can serve you depending on what your goals are. But so to someone looking through that view, basically everything they own is a public and liquid security. That's, looking at a private placement to invest in real estate is a radically different alternative investment, right? And so here are some of the benefits that I just want to add on for investing in such an alternative. So number one, you are giving up liquidity. When you purchase a public bond or a public stock like the S&P 500 index, you are getting liquidity. You can sell it immediately. And with that, you're paying a premium. So you are basically getting a lower return baked into the deal in order to have that liquidity. It's called a liquidity premium. So if you want the liquidity, then it's probably worth paying for. But if you don't want the liquidity, then why pay for something you don't need? And so furthermore, liquidity may seem great on paper, but actually liquidity can be your worst enemy because humans are emotional. I'm emotional just like everyone else. And if you wake up and have a bad day, or if you're going through a rough time or something, you might be tempted to sell your public or liquid securities. And maybe stocks are down and then you're freaking out. And so you sell. So then, your emotions cause you to sell when the stocks are down, when everyone knows that you need to sell when it's high, right? But emotions,
Conceptually.
yeah, emotions can get in the way. And so I argue that actually illiquidity can be a big benefit because it protects you from yourself. So private placements and private investments in real estate offer, I say offer kind of tongue in cheek because it's actually technically a downside, but it offers illiquidity. It's kind of like you put the money in and you set it and forget it. You can't touch it. You can't just sell the stock the next day. Now you own a piece of this venture and you're in it for the long term. Now, every deal is different. Some deals have a 2-year business plan. Some deals have a 10-year business plan. So you need to still calibrate to what makes sense for you. But I do really love the way that I can just put capital in and it forces me to think longer term like a Warren Buffett style investor, which we all know how that works. It works very, very well.
Yeah, that's a good point. So, if you're an investor in one of our opportunities, if you're thinking about it, just realize that these are illiquid investments. If you're looking to pull out at some point, you cannot do that until the deal is basically fully satisfied. So, that's actually one of the things when I do talk to my personal friends about it that they are struggling to wrap their arms around, which is fine. Maybe it's not for them, not for everyone, of course. And syndication isn't for everyone. A lot of people want to have full control and autonomy. They think, for the better or worse, sometimes they're right, sometimes they're wrong, that they can do it themselves. You're basically, not at mercy, because that sounds like a bad way to phrase it, but you're subject to the sponsor that you work with, that you invest your capital with, for the decision making to set up the right debt and equity structures. That is a either pro and a con depending on who you are and how you look at it. Funny enough, though, Rob, to your point, Daniel Humland would agree with you that the best part about syndications is the fact that you can't just access and tap into it and liquidate it at a moment's notice. So it does take some of that emotional decision out. So that's a good thing. Now back to where we're going to move the conversation forward. Lone Star Capital, kind of our mission statement, if we have one, our North Star with kind of where we want to go, and kind of our goal AUM for people who are working with us currently. They might be interested to know that, and also people who don't know us, just so we can show them the direction the ship is going.
Yeah, sure. So our mission statement, if you will, is to be first-class partners delivering superior risk-adjusted returns. So to unpack that, the most important thing to us is we want to be first-class partners. We want to communicate the best. We want to provide the best customer service. Investing is risky. It's emotional, and there's a lot of trust involved. So we want to validate that trust and give investors a comfortable place to partner and to invest. And that takes good bedside manner, right? You can't just run off and go do the deal and say, hey, trust me, and I'll be back in 5 years and let you know how it goes, right? That's not how we operate. We obviously provide monthly updates, quarterly reporting. We respond back to investor inquiries in 24 hours or less. So that's very, very important, and it's baked into the culture of Lone Star. And then as far as delivering superior risk-adjusted returns, this is our mission to not only find the right deals to invest in at that given time in the market, but also operate them well and deliver on providing great returns as an alternative to the 60-40 stock and bond split, right? So we are always innovating and looking for ways to deliver on that promise of superior risk-adjusted returns, whether it be unique tax strategies or helping investors get access to the lucrative tax benefits of our investments so that they can save on their personal tax liabilities and really get the most juice out of their investing dollar. So that's not necessarily, just to clarify, in pursuit of the highest returns, right? We're not trying to necessarily make every deal a 2x, 3x, 5x, or 20%, 30% IRR. We're actually typically very happy with a 15% IRR over a projected 5-year investment horizon. But the important thing is that the risk is under control, right? So at whatever return level we are targeting, we want to make sure that the risk is commensurate or better.
Incredible. How many employees do we have?
So we have about 140 employees if you account for the on-site staff across the 22 property portfolio. Each property typically is staffed with around, say, 5 or 6 people. And so that's usually split 50-50 between your office staff, which makes the property run from a leasing, collecting, and management perspective. And then the other half is, of course, maintenance. Maintenance is one of the most important parts of the business. The number one reason why a tenant moves out is because they're unhappy with the maintenance of the property. So especially when you're dealing with workforce housing, it's just critical. You have to be able to provide a good, clean, functioning product. And one of our missions at the property operations level is to have high renewal rates, because we just feel like that is, for many reasons, the number one indicator of a successful, healthy community. If people want to renew their lease and stay, and I always preach that a renewal is worth more to us than a new lease. Keeping someone is more valuable than getting someone new. I'm sure you can resonate with that if you're listening, in different styles of business
It's the
from
same
like
thing
a
as a repeat customer, right? You'd rather
exactly.
have a repeat customer, someone who keeps running, recurring it. Recurring business is better than having to find someone new. They go through the process of onboarding them. The onboarding process would be the same thing of turning over the unit, making sure that the carpet, the paint, and all that looks fresh and new, that the tenant deserves. So it's the same principle.
Yep, that's exactly right. So yeah, that's kind of a little insight on operations
So
and our
yeah,
employees.
yeah, so we have 140. So how many on the corporate team? Could you touch on that? Obviously, you mentioned we have about 140 far and wide between all on-site teams throughout. But corporate side, how big are we now on that side of things?
Corporate
Because I
side
think
is
people are
yeah,
usually surprised.
I think it's like around 17.
Okay, perfect.
So and a good portion of that is in Texas, and then kind of like the core investment team is here in the New York office at the One World Trade Center. And the core, when I say core investment team, I'm talking about essentially acquisitions, investor relations, Kent and myself, of course, and asset management.
Perfect. So would love to kind of have a breakdown of kind of each function of the team and the business, or not really the business, but the team, if you will. So like, what I do, Brad does, Dasha, kind of the IR side, things of that nature. And then kind of what Kent does now, kind of your role, if we could kind of, maybe just break that down briefly.
Sure. So I'm the CEO of Lone Star Capital. So I oversee all day-to-day responsibilities, ranging from acquisitions, marketing, investor relations, asset management, operations, and HR. So that's that's as simple as it gets there. And then on Ken's side, he is the other co-founder. He focuses on, given his tax and legal background, he focuses on all of our tax and legal related matters. He also focuses on special projects that we have, such as our affordable housing initiatives when it comes to partnering with our nonprofit partners as well as our housing authority partners to form these partnerships in order to create these affordable housing ventures. So that's the magic on Kent's side that I'm, if you've listened to the podcast, you've heard us talk about a lot. And then Brad Oliver is our director of acquisitions. Him and I work closely on identifying, sourcing, underwriting, and negotiating new opportunities. So we target to acquire around, 200 to $300 million in property per year, and so that we would like that to be comprised of, 5 to 6 deals. So that means pretty much at any given time, hopefully, ideally, we have a new deal under contract and a new deal that we're pursuing, and just keeping the pipeline full.
Yeah, it makes it a touch harder when treasuries are north of 4 or 5. But that said, you did write this book, which is a very, very specific and niche down book that's really only specific to multifamily underwriting and underwriting generally speaking. This is your book. Between this book and this book here, Rob's books have sold about 30,000 copies. So if you're someone who's new and is unaware of, kind of how the system works and you want to get some really easy digestible information, if you like to read, I'm looking at about 200 pages here in totality here that is really nutrient dense. Rob wrote those books, and it's kind of funny. I think people think now that Rob, of course, he's very prominent and key in the underwriting process, but Rob does not actually, in fact, underwrite the deals anymore. I think people think that he does that still, which is almost kind of funny, as if you don't have other big problems to solve. That is not what you really do anymore. You obviously fact check, or not fact check, you will, but kind of red light, green light, key assumptions at the end prior to going live and doing the best and final processes. You're very instrumental in that process, but you are not doing that as much as you used to. That is now what Brad does full time. He's speaking with the brokers. And I think one thing people ask us, oh, do you do off market deals? Do you sell your deals off market? We go through broker channels to acquire opportunities. Off-market deals, usually that's some sort of a snake oil sale, or no one else would buy it for that price, so you might be the sucker buying it for a silly price. In most instances, there are exceptions, but exceptions don't disprove the rule.
Yeah, that's a whole other
Yeah,
subject
can of
there.
worms. So let's go to Dasha's role, if you will.
Yeah. So
Dasha's Rob's sister, not wife, by the way.
So basically our investor relations department is comprised of myself, because I spend a lot of time there, you, and then Dasha, my sister. who is the director of investor relations. And so we're kind of like a 3-person team who focuses on uh, building new investor relationships, managing existing investors, and then actually going through the capital formation process for each and every deal. Because something that we didn't really fully explain, because we get this question a lot, is that we don't operate out of a fund. So we don't raise fund vehicles. We actually raise capital on a deal by deal basis. So every time we find a new opportunity that we like, we put the deal under contract. We put up our money first as risk capital to get the deal under contract, and then we actually put together the private placement and do a private offering to our investors, at which time an investor, many of our investors repeat invest and invest into many of our offerings over and over again, which we are incredibly grateful for. And that's really what we're in it for. We don't want to have to chase new investors for every deal. That would be a nightmare. So yeah, that capital formation process, I'd say, definitely you and Dasha lead that effort. You guys decide who comes into the deal and for how much, and there's different nuances there. But yeah, we're typically raising $15 to $20 million per deal, and we have to do that in around, say, 60 days.
Yeah, that's fair. That's very fair. And then we've got 3 asset managers as well. If you want to maybe just share, or actually maybe more now, technically, if you want to share kind of that side of the business, because they're on the corporate team. But it's kind of funny. They have almost a hybrid approach, because they are, of course, interfacing with yourself, but then they're also sitting in New York, and they also interface with, the bulk of the employees, which are the on-site staff teams, and they do, really important work. So if you want to maybe just touch on kind of the positions there, what they do, the functions, so on and so forth, the reporting.
Yeah, the way you described it's really good. Asset management is definitely a bridge between the on-site management and kind of corporate management. So asset management does a great job of blending the on-the-ground responsibilities of leasing, collecting rent, managing properties, accounting, and then taking all that and then actually kind of layering it up to a more strategic level, where we have business plan, construction plan, refinancing, insurance, taxes, sale. So it's obviously steering the overall vision, but then also managing the day to day from a personnel perspective, from a processy perspective, and so on. So when it comes, I'd say a big function, which we're actually in the middle of right now, is producing reporting. So asset managers are charged with the responsibility of obviously being involved in all the day-to-day operations, so that we can report to our investors on a monthly basis all the updates that's going on at the properties and the progression of the business plans.
Nice. Cool. And then let's go to reporting. What does the reporting process look like? Because that's very crucial. It's kind of a touching point for a lot of people in the business, particularly with who we work with. If you're a capital raiser, an investor, that's one of the FAQs that I certainly get during the kind of introductory call.
Okay, sure. So I touched on this briefly already, but we provide monthly updates, which include just basically any highlights that are worth talking about, as well as a link to the full financial package. So if an investor ever wants to dig into all the financials, they're right there on a monthly basis. And then on a quarterly basis, we produce quarterly reporting, which kind of has all the information that you would want. Namely, you have the variance report, which is basically, all right, here are the projections line by line in the underwriting that we use to derive the projected returns for you, the investor. And then here is the actual performance. And then this is the variance, and here's why. So if vacancy is higher than projected, we might say, okay, it's for XYZ reasons. Or if rents are higher, or if payroll's up, we might have an answer for that, and just kind of go through the whole thing. And then hopefully in the end, it all shakes out and we have the bottom line number, which is hopefully ahead of projections, because our goal is to underpromise and overdeliver, and that's how we can gain repeat investors and scale the portfolio and essentially perform. So those are the 2 critical reporting components. Another important thing for these private placements is the investor's K1. So a K1 is basically a partnership return. So when you're investing in this deal, you are, or in a private placement like this, you are getting a share of a partnership. And a Schedule K1 is an IRS form which basically shows you, the investor, what your share of the partnership looks like from a income and loss perspective. And the beautiful thing about our business and about the deals that we structure are that the properties, the investments generate paper losses, which are non-cash deductions for investors. This is one of the big reasons why a lot of investors invest with us rather than investing in like a public REIT, which would be basically a similar investment profile in real estate, but publicly traded liquid security, which doesn't provide the tax advantages of receiving a K1 every year, which typically gives you a loss, which you can then use to offset other income in your portfolio, and not only the income of that investment itself to try to optimize so that the income generated from the investment is all deferred on a current basis. And then with the North Star, with the goal of being that when we sell in 3 to 5 years or so, we 1031 exchange, which is another tax deferral strategy, and continue to defer the taxes, because a big thing that a lot of investors neglect is their post tax return. A lot of people look at pre-tax returns. They look at, oh, Bitcoin from here to there, or S&P 500 went up 15% last year. And that's all true, and that's great. But if you were to buy at the beginning of the year and sell at the end of the year, you'd have a hefty tax bill. And so we take it a step further, and we actually look at and try to plan and optimize for what an investor's eventual post-tax return might look like, which if you don't plan ahead and optimize for that, you might have a great pre-tax return, but then your post-tax return actually comes down quite a bit. And now the investment that you thought was so good is maybe actually mediocre.
Very good. Very good. Yeah, once more, monthly reporting, monthly distributions, very crucial. Green lights, not quarterly. You're always going to know how the investment stands. I think it's a very, very big component to us. Now let's get into who we work with, how we take capital, and our capital formation process.
Yeah. And then also, I know you just mentioned it, but you mentioned it kind of quietly. So I'll mention it again. We do, and I failed to mention this, we provide monthly distributions. So that means every single month, investors through our investor portal have their bank information connected to the investor portal. And so that there's just a direct deposit ACH every month as we make cash flow distributions from the project.
And also, just from a holistic perspective, and we'll get into this in a couple of items here, but we're looking to buy deals that are not wildly distressed. Okay. There's a lot of people that sell, oh, buy really distressed deals because there's a big lift. It's like, well, it's not that easy, and there's a lot of risk associated to that. Plus, you got to catch up on the pref. When you do pay down your monthly amount, when you do pay out monthly distributions, you really do help pay down your preferred return, which is very important for investors. That also keeps us competitive as well too, compared to other kind of investment and alternative investment vehicles. So let's go to who we work with, as in investors, how we take capital, and then our capital formation process.
Yeah, so we work with a diverse range of investors, ranging from high net worth individuals. Our minimum investment is $50,000. So we have, certainly many people investing at the minimum of $50,000 per deal. But we have high net worth individuals that are putting in $250K or $500K per investment as well, and potentially even beyond. And so that's a big cohort for us of these high net worth individuals. And then we also have a very big part of our business coming from fund managers. And so fund managers are partners who are usually pooling together $1 million to $4 million, and they have their own network of investors. They pool together that capital into what is called a fund of fund, and then once capital is pooled at their fund, then their fund writes a single check into our deal. And so this gives them, because they're investing a larger sum with us directly, gives them preferential terms at the deal level. And then they can basically share those preferential terms with their investors while taking a piece for themselves as compensation for putting together the fund of fund and for managing the fund of fund over the life of the investment. So it's like someone investing into that fund gets kind of like dual support. They have the support of their fund manager, as well as, of course, support from Lone Star Capital, the lead sponsor of the investment.
Makes sense. And then we also take 1031 exchanges into our deals. Rob, can you explain the 1031 and then also the form in which we take it in?
Sure. So another big part of our business actually is, as you said, 1031 exchanges, which we facilitate through a tenancy in common. So this is a little bit complex and, potentially, out of the scope of this conversation. But if someone is serious and wants to learn more, we can most certainly set up a call. Dasha on our team is actually our 1031 exchange expert.
Guru.
So we'd love to set you up with her. But basically, through these tenancy in common, someone can sell an investment property that they currently hold and then defer the capital gains tax associated from the sale and roll over the gains via rolling over the gains into an investment with us. And so I say with because it's actually a tenancy in common. If you're familiar with the structure, basically is joint direct ownership of the real estate. And basically the 1031 exchange investor owns the real estate directly, as do we, and then we manage it together through a TIC agreement, through a management agreement. So that way, while the investor is compliant in their 1031 exchange and they are owning the real estate directly, they can transition from what previously may have been an active ownership role in that investment to now a more passive ownership role, because now there's professional management involved for the new deal that they 1031 exchanged in.
Perfect. Cool. I think that covers the capital formation process. As mentioned before, we're typically raising between 10 to $20 million, pretty broad range there, but 10 to $20 million, depending on the deal size into our opportunities. And then also, I think we will get to this, but the size of deals that we'll buy, that's actually coming up in two things. So I jumped the gun there. Becoming vertically integrated on the property management and construction management side of things. First off, what does that mean, vertically integrated, for this reference? And why did you do it? And when did you do it?
So in our business, if you are a sponsor or a syndicator of private real estate, that's one side of the business, right? And that side of the business entails acquisitions, asset management, investor relations, and there's a whole other side of the business, which actually is literally a whole nother business and a ton of work, which is the actual management, the day-to-day management of the real estate, as well as the construction management of the real estate. And so there's varying levels and definitions of this, but essentially what it means to be vertically integrated like us is we have those capabilities in-house. So many companies like ours actually outsource the management and the construction to third-party management firms. And that's well and good. I'm not going to say that's a fail. That's not a bad strategy, but there is a ton of benefits involved to being vertically integrated like us, where we can be more hands-on with the management. We can be more cost conscious. We just have more control and transparency to be able to affect better outcomes for investors.
Also, I think for reporting, that's probably the biggest factor, or one of the larger factors, that we are able to report very quickly, as opposed to waiting and relying upon the third party people to do so.
Yep. Yeah. I mean, over certainly I've learned this the hard way and through experience. Just because you're vertically integrated doesn't guarantee results. You have to work at this. You have to actually build all the right tools, and whether that be from an accounting perspective, like you just mentioned, or from a human resources perspective, or from a processes perspective, we're constantly looking for ways to innovate to manage our portfolio better.
Yeah, without a doubt. And when did we get property management and construction management in-house?
2021.
Excellent. Okay. Where we buy, I think we've covered that. And why do we buy there? I think we've actually covered that already. But can we talk about the size of deals that we typically buy?
Sure.
Unit
So
count?
yeah, we are looking to acquire properties that are 40 million and greater. This is just in alignment with our goals of scaling, but not scaling with hectic acquisition pipelines where we were closing on deals every single month. We would rather not offer, a million investment opportunities per year to our investors. We'd rather just offer, 4 or 5 or maximum 6. And so the $40 million deal size, it makes us, I would say, relatively agnostic to the unit count, but the unit count for these deals is typically somewhere between 200 to 600. just depending on the quality of the property and the quality of the
Location.
location, which is going to then
Yeah.
dictate the per unit cost of the property. So I would say the sweet spot for us is we buy a lot of property that is right around the 150,000 per unit range in Texas. That is the sweet spot for upper workforce housing, I would say. So for properties that are built kind of in a combination of pretty strong location as well as pretty recent construction, like built in the last 20 years or so.
Cool. Awesome. Then let's go to what markets do we want to expand into in time, and then how much do we want to own in each market, which I think is an interesting caveat.
This year in 2025, our plan is to begin expanding into Phoenix. So this will be a big point for the firm because it'll be our first time focusing on property outside of Texas. With that being said, we'll continue to heavily focus on Texas, and we're not abandoning that market by any means, because we have the goal of having material concentration in any market that we own in. Because we're vertically integrated, it really makes a lot of sense to have economies of scale, and you can only have economies of scale if you own properties that are geographically clustered. So if we can own, for example, 1% of the inventory in a particular market, that can make us a major mover and shaker to where we can get differentiated deal flow. We have strong knowledge of the market, given the existing data that we have by owning 1% of the market. And just to give people reference, Phoenix, for example, is around a 300,000 unit market. So if you own 1% of that market, you have about 3,000 units. So that gives you the size, the sense of scale that is required to really, have a decent sized portfolio to be able to get economies of scale.
Excellent. So then what type of deals do we buy? As in not like, oh, are we buying industrial? Are we buying, mixed use? But, age, vintage, quality, things of that nature. Do we have a one size fits all approach, or are we open minded throughout what the market will give us?
So we do focus, just to make clear, only on buying existing multifamily. So we don't do other asset classes and we don't do development. So we buy existing multifamily. It has all been in Texas, but now we're looking to expand out further. And our strategy varies. We've historically been a buyer of value add, which has been a very popular strategy. And then towards the end of the cycle, kind of into 2022, value add deals became very scarce, just because of the competition of the market and because of the way of the cycle. A lot of deals were already renovated and there wasn't a lot of meat on the bone. And so we began pivoting to an affordable housing strategy, which was contrarian and going against the grain, because rather than buying a property and trying to renovate and raise rents, we've been actually buying property and maintaining its stabilization and actually restricting the incomes and the rents for the residents in exchange for property tax exemptions. So actually lowering rents while still being able to target strong mid-teens returns similar to a value add return profile. So I think it just depends on where we are in the cycle and the deal at hand, that will determine our strategy. We definitely don't look at it like, a one size fits all situation.
Perfect. How many investors do we have?
I think we have over 2,000 investors.
Crazy. How can you get involved if you're, maybe just an investor, if you're a capital raiser, how can someone get involved and work with us?
Well, the best way for someone to get involved is to go to our website, lscre.com. And on our website, there's a new investor contact form. You could fill out that form. Craig will give you a call right away,
Very
and
prompt.
he'll chat with you to see if you're a good fit to work with us, whether it be from an investor perspective. Again, our minimum investment is $50K, but we have different tiers of investment ranging from $50K, $500K to $1 million, and up, of course. Or if you're a fund manager who has, maybe you've raised capital before, or you have a little bit of experience and you want to, work with a better sponsor like us, reach out as well. We'd love to connect with you. We'd love to grow with you in the business and help you achieve your goals of raising more capital into high quality deals with us.
And then final question. I think this is super important. Experience. What is the experience like of working with Lone Star Capital? How would you describe it from your perspective for our investors and capital partners?
Yeah, I touched on this before, but for me, it's communication. It's our hypervigilancy. We're always responding to emails right away. We're getting back on the phone right away. We're we're in constant communication. We're very transparent. Everything we do, we try to be buttoned up. We try to be very professional. It's in line with our image as far as being suit and tie, being in the corporate office, and so on. So, yeah, I think it's a very professional experience working with us, which, funny enough, you would assume there'd be more of that in our industry because this is finance and this is investing and we're dealing with a lot of money and this is a really important business. But unfortunately, or for better or worse, a lot of people in our industry don't really act that way, and so there's some issues there perhaps. But we're very professional, very buttoned up. Yet I would say not unapproachable, and hopefully we have some fun. For any investors who do work with us, we try to put on good investor events and education opportunities, networking opportunities, nice dinners, retreats, and things like that.
We
So
make ourselves very available. I'll just put it that way. We make ourselves very available. We want to wine and dine you, take care of you. I'll even take you to play golf.
Craig will even take you to play golf.
Perfect. Well, I think that summarizes us. This went longer than you thought it was going to be. It went exactly as long as I thought it would be. If you knew all this stuff, but this is a nice refresher, thank you so much for tuning in. If you're new and are looking to connect with me, please reach out to me via email. My email, you've heard it before, but if you've never heard it before, here it is. It is Craig at lscre.com. Once more, Craig at lscre.com. We are taking on more partners, more capital raising folks, more investors, so on and so forth. We're really trying to super drive our growth and fuel what is next. There's always room for more friends, more people in business that are working with us. We want to have a deep bench and bullpen of people that we work with and call from, and it only helps us grow our pot and kind of our network. So that's super important to us. We would love to work with you. If you have been listening to this and think that someone else would be a really good fit for hearing this and working with us, please, please, please help us and share this with them. So often, actually, people do that and it's really helpful. And then also there's a lot of people that listen but don't actually reach out. I actually had a really cool conversation the other day with someone who watched one of my podcasts and started capital raising, but we hadn't spoke yet. And then I actually messaged him, and it was an incredible conversation. That's someone that I really hope to be working with. But all that said, if you've been listening to this and you haven't reached out yet, please do it. If I knew you were listening, if I knew those views on YouTube and Spotify, if I knew you were, I would be messaging you, but I don't have that information yet, or ever probably. But please, we would love to work with you, particularly if you're a captive audience. So we hope you found this useful. We will let you go, but thank you so much for your time today. And as I said, please share this if you think someone would find this valuable.
We'll see you next week.